Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Greetings. This is Ivan Elon, the founder and chief investment officer at Aligned Wealth Advisors Investment Management, also known as AWAIM. Thank you very much for joining me today for this month's edition of our podcast, Deep Economic Thoughts with Ivan Elon. That's me. So I wanted to talk today about digging a little bit deeper into the topic that I wrote about in this month's research highlight, which was published April 9th, yesterday, on our website at alignedwealth.com, A-L-I-G-N-E, wealth.com. And if you visit the website, go to the For Advisors tab, drop down to research highlights, you'll see it and the chart it references. There's a couple of charts inside that particular published item, and the subject of it is information technology represents 5% of U.S. GDP, but 30% of the U.S. stock market. And really, when you think about what this is referencing, and this whole line of thinking is something that is really a riff on how Warren Buffett looks at valuation in the marketplace. And so there is something called the Buffett ratio or the Buffett indicator. And essentially, it's a pretty simple formula. All it does is it takes the total market cap of the U.S. stock market and divides it by the U.S. gross domestic product, or GDP. And so if you take the Wilshire 5000, divide that by the GDP, you'll get a ratio, and you can look back historically. There's a lot of online charts that show this historic movement around it, but right now, where we stand right now is somewhere in the 186%. That's the ratio. So the Wilshire 5000 is 186% of the U.S. GDP. And it's pretty much sitting at an all-time high, looking all the way back to, I think, this chart I'm looking at, which is on longtermtrends.net. It goes all the way back to December of 1970. So the last time it got close to this level was in November of 21. So it's kind of an interesting indicator looking at the total value of all the publicly traded stocks or companies in your economy and dividing it by the size of the economy or its GDP. You get this ratio. Well, I wanted to go a little step further and dig a little deeper into that. What if you apply it to particular sectors within the economy? And so in the research highlight, again, that's published under research highlights on our website, I focus on really two specific sectors: information technology and also financials, the financial services sector. So again, the information technology sector is only about 5% of U.S. GDP. That's all it contributes to the economy at a macro level. However, it represents 30% of the U.S. stock market value. So this is a bit of right away you start to scratch your head and wonder, well, wait a minute, what does that really mean? And that I think is the right reaction. Why would only a 5% contributing factor to GDP represent such a huge portion of the total stock market within that very same economy? Now, if you compare that to, for example, the financial services sector, which is what is being done in this highlight, the financial services sector represents 20.7%, so almost 21% of the U.S. economy is, as measured by U.S. GDP, so 20%, 21% of GDP of the U.S. is attributed to the financial services sector. However, the total market cap is only 15.52%, so just call it 15.5%. And that combines both explicitly financial services plus real estate, because the way that the U.S. Bureau of Economic Analysis presents this data, it combines finance, insurance, real estate, all of that in its GDP percentage figure. So a 21% apportionment, 21% of the economy is attributed to the financial services sector. However, the total market value of those companies is only 15.5%. So that's way, just call it 600 basis points or a full 6 percentage points below. The market cap is a full 6 percentage points below where the GDP allocation is. So that would be a ratio much smaller, because you have that market cap being a much smaller figure relative to the size of its contribution to GDP. Whereas the absolute inverse is seen with information technology, with it representing 30% of the market capitalization of the total U.S. stock market, however, representing only 5%, specifically 5.4% of U.S. GDP. So that is, so if you're wondering why the Buffett indicator may be so incredibly high right now at 186%, looking at stock market value divided by GDP, it is certainly coming from this information tech sector that is contributing significantly to this overvaluation that occurs. However, if you apply this like we did with the financial services sector, we're way below that, and the ratio is not anywhere near 100%. And so technically that could be considered an undervalued item based on that particular formula or that particular approach of taking market cap and dividing it by GDP. We're just adding this extra layer or filter on this Buffett indicator by looking at sector-specific contributions to GDP and looking at the size of that sector and its market cap relative to its contribution to the economy. So it's really very stunning. And so there's obviously a lot of ways that you can look at market valuations and whether a sector is overweight or rather overvalued versus undervalued by the U.S. stock market relative to its contribution in the economy. This is a very interesting way to go about that. And certainly it would reinforce our feelings around the information tech sector, specifically, these mega large cap companies that have been dominating the S&P 500 over the past year and a half, essentially. And it certainly makes us more comfortable to remain away from an overweight in information technology, and that's why in our portfolios we maintain an underweight to information technology. Not only because of the price-earnings ratio, not only because of the price-sales ratios, which are significantly high and really indicating overvalued in that particular sector. Now you look at something like this, this variation on the Buffett indicator, looking at the market cap relative to its contribution to GDP, it's also signaling a significant overvaluation in the marketplace. So a little bit of an interesting twist to using a popular metric from one of the greatest investors of all time and all history, Warren Buffett, and how he views the stock market and whether it is being overvalued or undervalued at different points in time. Applying that same logic or formula to sector-specific areas within the economy, I think can provide some interesting insight and additional perspective. If you have any other questions at all, we're always open to your questions and things that you may be curious about in the economy or the capital markets. Don't hesitate to reach out. You can visit our website at alignwealth.com. That's ALIGNE wealth.com. And you can simply go to the contact page and enter your information and ask any questions you'd like there. You can also just give us a call in our offices headquartered in Los Angeles at 310-795-0622. That's 310-795-0622. And you can hit extension 101. That's my extension. And if I don't answer, it'll go to voicemail, but someone on the team, maybe even me, will get back to you, and happy to have a conversation. We really believe that education is a very important aspect of participating in the capital markets, and we're happy to make our contribution in that way. Have a wonderful day, and thank you so much for joining me today, and look forward to having you join me again in the next podcast next month.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilorn.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.